week, right, we were talking about international financial market, right? Let's quickly go to the lecture note. In this topic, right, we will look at financial market from the perspective of company, right, that raise fund, right? And after we finish this topic, right, then we move on to the other side of the market, that is from the perspective of investor, right, who look at financial market as the opportunity to invest, right, and generate return. But firm look at this market as the source of funding, right? I understand that I have gone through this. Let me go back a little bit, right? This overview part, right, talking about financial market, talking about two channels that capital can flow, right, from investor to firms, right? We have commercial bank system, then we have financial market, right? And along the way, I also mentioned about reference interest rate, right? If you go back one step, okay? Now, and then I understand that I have also mentioned about international financial market, how it is different from domestic financial market. Right? Basically, a financial center, right? A financial center or a country, right, will be considered as international financial center or not. Depends on whether the regulator, right, whether the regulator allow financial institutions, allow investors, right, in the market, right, to enter into a cross-border transaction, right, that result in capital flow, right? And then I show you different kind of cross-border capital flow transaction, right? Out, in, and in, out, right? Now it depends on the regulator whether they allow all these transactions to take place or some of these transactions to take place. And that result in different degrees, right, of openness, right, of the market, okay? Right, that's the overview, right? Now, what I want to start today, right, is that I want to start with the first section of international financial market. This is known as Euro currency market. You can think of this as an offshore banking, right? You can think of this market as an offshore banking, right? Let me start with the origin so that you get the idea first, right? How this all begins, right? And then I talk about the definition of this market, right? Nowadays, right? How do we define Euro currency market, right? And then I will talk about some instruments, right, that firm can use, right, to raise fund. Basically, this market, from the firm perspective, this is for debt financing, right? This market is basically to borrow money, right, from the firm perspective. Okay? Apparently, the origin of Euro currency market is not that far back, right? This market started in around 1950s. This is when, right, the international community just start to adopt the Bretton Woods system, right? If you can still recall that, the gold exchange standard system. So we know that under the gold exchange standard of Bretton Woods, right, US dollar is the center, right, of the financial market. So because of that Bretton Woods system, right, there has been a lot of demand for holding US dollar outside USA, right? So if you think about this as a country, USA, right? This is the US. right? And outside USA, a lot of countries, a lot of firms, right? A lot of consumers, right? They have the demand to hold on to US dollar because when they do transaction, they use dollar to settle, right? Transaction, even though, right, that's outside USA. So a lot of demand for US dollar. So that caused capital outflow, right, from the US to go out. But at some point, that capital outflow was too much until it became very expensive for US firm, right, domestic firm in the US, right, to raise fund because they have to compete with foreign firms that also want to raise US dollar for their investment, right? So this process caused the cost of capital for the US firm to increase. Right? And suddenly the US come up with a policy, right, to control the movement of dollar, right, to go out, if that is for investment purpose. So slow down that. But still, right, outside US, there's still a lot of demand, right, to hold on to US dollar. So a lot of demand for dollar is not met, right, outside USA. And at the same time, right, there are some countries and some entity outside USA that has US dollar on hand. So that they want to look for places to invest that dollar. But they are willing, they're not willing to deposit this money back, right, to US bank. One of the main reasons being that they are afraid that the US government might have access to that account, right? And if there's dispute between countries, the US government might freeze that account, and then they would be unable to, right, withdraw the money. So this creates supply of dollar outside USA that look for investment opportunity, but doesn't want to go back, right, to invest in the, let's say, deposit money with US bank. So this situation, right, create, right, both demand and supply for US dollar outside USA. Now, we just have to wait until somebody, right, come into the middle here, right, to make this demand and supply to meet each other. And apparently the very first bank that is willing to take deposit in US dollar and make loan in US dollar outside USA happen to be bank in Europe. And that's probably why they call this market Euro currency market. And one of the very first bank to take this deposit, which is in foreign currency, right, from the perspective of the bank, right, and then lend this money, right, also in foreign currency as well, right, from the perspective of the bank. And that bank has to be, happen to be banks in London. They are among the first one that accept this kind of deposit and loan. So, and that also due to the fact that the UK government, right, would like to have London, right, to be financial center. You have to understand that at the end of World War II, right, the UK economy, right, was shattered by the war, right? So the UK was about to lose its status as the global financial center, right? And in order to bring back that kind of status, the UK government also have a law that allow banks in London, right, to take deposit in foreign currency and also make loan in foreign currency, basically to facilitate this demand and supply. So that's where Euro currency market start, and it started in London first. And nowadays, right, London is also the biggest Euro currency market. Okay, so that's how things begin, right? The name Euro currency market actually came later, right? At the beginning, they don't call that kind of transaction as euro currency transaction. That's just an offshore banking, right? But later on, right, the market participants, right, start to use this term to describe the transaction, right, and the market. Okay, so today, right, when we talk about euro currency market, right, London was the first, right, but later on, other countries also open their offshore banking centers like Hong Kong or Singapore, right? So today, when we talk about euro currency market, right, we refer to a network of offshore banks. Basically, this is a network of banks, right, that accept, right, they accept deposit and make loan in foreign currency. Bank in London accept US dollar deposit and make US dollar loan. Bank in Hong Kong, right, also let's say make deposit, right, and loan in US dollar, right. So that's foreign currency outside the country where the currencies are issued. So in London, right, you can deposit not only US dollar, but also Japanese yen, right, and other currencies. Right? So that's the example of euro currency market. The supply of euro currency, right? The supply of euro currency is mainly in the form of fixed term deposit, foreign currency fixed term deposit. That is written in the form of negotiable certificate of deposit or NCD. To understand what I try to say here, right, you have to go to the next slide. This is the way we measure money supply, right? This is the way we measure money supply, right? Start from coin and banknote in circulation, and then plus demand deposit. Right? The sum of these two is called M1. Different countries will use different definition of money supply. Like in Thailand, we might mainly focus on M1, right? But in the US, right, saving account, right, saving account might be as liquid, right, as demand deposit. So in that case, when they want to measure money supply, they might want to focus on M2. Now, if you expand the scope a little bit, then you will encompass term deposit as well. Now, in euro currency market, apparently most of the supply of euro currency is in the form of term deposit. And that term deposit is written in the form of negotiable certificates of deposit. What does it mean, NCD? You have to think about bank account first. Normally, when you put money, right, in term deposit with a bank, right, they give you bank account, bank book. Let's say, right, this deposit is 6 months. So basically, depositor have to hold on to that bank book for 6 months. At the end of the deposit term, right, receive the money back plus interest, right? So that therefore, depositor, right, will have no liquidity, right, for the next 6 months because now they hold on to the bank book instead. During that 6 months, if depositor want to withdraw money, right, want to use the money before the end of that term of 6 months, right? If this term deposit, right, is issued in terms of bank account, so depositor have to go back to the bank, right, and then ask the bank that we want to withdraw money before maturity. So the bank will return you the principal, but the bank has the right to not to pay you the interest, even though you have put the money with the bank already for 4 months. The bank have the right not to give you, or the best they give you would be interest rate equal to saving account. So you lose the opportunity, right, to earn interest that for that 4 months, right, that you've been waiting, right? But if the bank book, right, is written in terms of negotiable certificate of deposit, you can think of NCD as a tradable bank book. This is written in such a way that the document is tradable. So after the depositor wait for 4 months and now want to use the money, but still have 2 months, right, left in that term. So depositor, rather than going back to the bank, right, they can actually resell this NCD to a third party. And the third party, right, after receiving this NCD, only wait for 2 more months and will get back principal plus interest. And that interest is 6-month interest. So normally the buyer of the NCD will also compensate, right, to the original holder, right, some interest, right, for the first 4 months that has already passed. So in this way, right, it becomes more liquid, right, for depositor, right, to hold compared to holding bank book. And euro currency is normally issued in that form. Okay. Even though US dollar was the first currency, right, for this kind of transaction, but today, right, euro currency transaction also include, right, other hard currency as well, like the yen, the pound sterling, and the euro, right? So if you want to talk about US dollar in euro currency market, right, we have a nickname for that. That is called euro dollar. Right, yen, right, in euro currency transaction, that is called euro yen. So simply add prefix euro in front. Then people understand that you are talking about the offshore banking for the yen, the offshore banking for US dollar. Okay. Later on, I will use US dollar as the example because this is not only the first euro currency, but it is also the biggest, right? The biggest euro currency, right? In offshore banking, right? Here, right? I would like to give you a brief explanation on how the supply of euro dollar is created, right? When we talk about euro dollar, we talk about US dollar being deposited outside, right, or with the bank outside USA. But this is US dollar. So it must be originated from the USA, right? Because that is the only country that can print US dollar, right? So any euro dollar, right, must have the same origin, right, from the USA, right? So let me explain how the supply of this is created, right? Let's assume we have a German firm, right, that export product to the USA, and that product is worth 1 million US dollar. Now assume that the US firm, right, make this payment, right, make the payment for this transaction by instructing its bank in New York to transfer that money to the bank account of the German firm that is also opened with another bank in New York. So in the third bullet here, right, the payment from US firm, right, is made to German firm. But since the German firm's account is still in with the bank in New York, so at that point, euro dollar has not been created yet. Okay. Now, at some point in time, right, the German firm might find that putting this dollar with bank in London might get better interest rate than putting the money with bank in New York. So later on, I assume that the German firm now want to move the money, right, move account, right, from the US bank to a bank in London, right? So the German firm then transfer the money, right, from US bank account into a bank account in London. At this step, this is when the euro dollar is created. Okay, let me go to the diagram. If you go to the next slide. So this is when the German firm, right, transfer the money, right, to its bank account in London. And this is the start of the supply, like, of the euro dollar. Now this bank, say, located in London, after taking the deposit, so that bank has the obligation to pay, to make interest payment, right, to the German firm. So in that case, the bank, right, must also make use of the dollar that is placed with it. So most likely this bank will lend that dollar to somebody else. Assume that another bank in London, Bank B, right, borrow money from Bank A. So this is called interbank lending, right? So the interest rate that occur here will be part of the LIBOR calculation. Now, after Bank B get the money, of course, Bank B want money because it can lend money to another person. So Bank B might lend that money to another private entity outside USA. And the interest that Bank B will charge would be LIBOR plus some spread. So through this deposit lending and deposit and lending, right, this whole process, right, it will start to generate, basically multiply the supply of euro dollar outside USA. Right, so the process of money generation is the same as what you have done in your macroeconomic subject, right? Money multiplier, same thing here, right? So this process will occur outside USA, right? And start to increase the supply of euro dollar. Okay, so that's how it is created, right? And multiplied in the market. Okay. Today, right? Today, when we talk about euro currency, right? Since today, euro currency include currency apart from US dollar as well, and the market is not limited to just in London, right? Other countries also open this kind of operation, right? So today, when we talk about euro currency market, right? We think about it as offshore banking, basically, right? Apparently USA, right, after seeing London, right, taking a lot of business, right, in offshore banking in 1981, the US also opened its own offshore banking, right, and in the US, the offshore banking section is called International Banking Facilities. Thailand, we did once, right? I can't remember the exact year, right? But I think it's approximately in 1993 or 94, right? Around there. Let's say 94. Thailand also opened offshore banking facilities in Thailand, right? We call that Bangkok International Banking Facilities, BIBF. How we open that, right? And basically at the time we would like to become like Singapore, basically. Singapore has that market a lot early on, 1960s, and become quite successful in drawing a lot of capital. You know, right? Most of the capital flow to Southeast Asia, right? Capital flow from foreign countries that go to Southeast Asia. Most of the money have to go to Singapore market first. So being offshore financial center, you kind of get the become like a dealer basically, right? And get the margin between bid and ask spread, right? So Thailand would like to do the same in 1994, but apparently that was one of the main contributor to financial crisis in 1997. Right, the crisis that we have in 1997, has something to do with that a lot of factors actually contribute to 1997 crisis, but this is one of the factors. And after that crisis, we closed down this operation. Basically, we don't have this anymore. So basically, offshore transaction in Thailand is very limited, right? So we are not that kind of center, right? To understand this market a little bit more, right? Euro currency market is a two-tier market. So in the center, you have interbank market, where bank and bank, right, borrow and lend, right, among themselves. The second tier, that is retail. Right? This is where bank facilitate non-bank customer, right, who want to either deposit or borrow money in foreign currency, right? Or when they said foreign currency, refer to the location where the bank, right, is operating. Okay. Interbank market, right, in euro currency, right, up since London, right, since London is the biggest euro currency market. Therefore, interest rate, right, of the interbank market in London has become, right, the most important reference interest rate for this market, right? So in London, in the past, right, in the past, British Banker Association was the party that take responsibility, right, to make the survey, right, in order to get a reference interest rate known as LIBOR. Basically, this is the same as what happened in Thailand, but in Thailand, the party that take responsibility, right, to survey this reference interest rate is Bank of Thailand, and the rate is called LIBOR, right? But in London market, right, it was the British Banker Association who take this responsibility and make a survey, right, of the interbank interest rate in London. And each morning, right, BBA, right, will announce, right, that number on a daily basis, right? So this is an example of LIBOR interest rate, right? This reported on November 12th, right? So here, right, you have dollar LIBOR, euro LIBOR, right, pound LIBOR, and so on. Okay, so when you talk about LIBOR, right, you must mention the currency of the denomination as well. Otherwise, people will not know which currency you talk about, because US dollar is not the only currency in the market, right? They report the LIBOR interest rate based on tenor of the loan, right, or the time to maturity, right, from overnight, 1 month, and so on, right? So this is the same as the table that I show you, right, for LIBOR, right, in Thailand earlier, right, in this lecture. Okay. The one in the middle here, these 3 columns, that's not interest rate, right, but that's the change in interest rate from previous day, right? This reflects the change in interest rate compared to yesterday. Okay. Later on, right, market participants will use this LIBOR as the reference interest rate, right, to do other transactions. Okay. I just thinking what I want to tell you here. Have you heard of this thing? Here, right, I have euro LIBOR. Have you heard of this? Euribor. Euribor, this one. That's the interbank interest rate for the euro, right? That's also interbank interest rate for the euro. But Euribor is the interbank market in the eurozone, right? Euribor is also interbank interest rate, right, on the euro, but from London market. So the difference between these two is that this is considered offshore market for the euro, right? That's offshore interest rate for the euro. The second one, that is onshore interest rate for the euro, right? But most of the time, these two numbers are quite close to each other. They are almost identical most of the time. Not all the time, but most of the time. Reason being that capital flow quite freely between the eurozone and London, right, causing onshore and offshore interest rate to be the same, right, most of the time. Okay, so that's the name of reference interest rate. Okay. Next. As I told you, right, LIBOR has become very important reference interest rate for market participants to use, right, when they want to enter into a transaction that relate to interest rate, right? But after 2008, right, after 2008, right, there was some misconduct, right, within the LIBOR report. Basically, banks, right, that's supposed to send information on the interbank interest rate to the BBA, right? They're supposed to send the interest rate that they either do the transaction or they actually quote to the BBA. But in 2008, right? But the fact is known after 2008. But during 2008, some bank they quote fault rate, right, to the system so that they can influence that number. But you might be wondering, how can you influence that number if that number is the average from many banks? Apparently, in the year 2008 and later on, right, the amount of transaction that go through LIBOR, right, that go through this interbank market has dropped significantly. So that means the actual transaction doesn't take place that much. So the number is not that liquid. Therefore, some banks, right, can have influence on the number, right? So that caused the international financial market participants to now, right, moving away from using LIBOR, right? But we still have to use it for the next few years still, right? Why this market, right, is attractive, right? To understand the attractiveness of this market, let me show you the next slide. This one. If we compare LIBOR, right, with onshore interest rate in the US, so I should compare that with prime rate. This is the interest rate that US bank lend to customer with good credit worthiness. So LIBOR is interbank. So if I add, right, spread to that LIBOR, so that would be the interest rate that companies can borrow US dollar from offshore market, right? The 7.25, that is the rate that company can borrow from US bank, right, onshore market. So the attractiveness of the offshore banking system is that to borrow money, right, offshore market tend to offer lower interest rate. And to deposit money, like it. To deposit money, offshore market tend to offer higher interest rate, compared to onshore market. So the attractiveness of offshore banking system is that the bid-ask spread that market participants have to encounter tend to be a lot narrower compared to when you have to deal with the same currency but onshore market. And this is why the market become attractive, right, for firms, right, for investors, right? But you have to understand that to get access to this offshore center, bank only deal with large customer. They don't deal with retail, very small customer. They don't do that. So they only deal with large transaction. And that is why they can have economy of scale and being able to reduce the cost of providing the service. But onshore banking, banks has no choice. Whether you are big or small, banks have to entertain you, right? So another thing is, right, in offshore banking, if we want to borrow long term, the interest rate that bank charge tend to be floating interest rate. It's very hard to get fixed interest rate loan for long term in offshore banking, right? But onshore banking, that's still possible. Okay, so basically whether firms want to use onshore, offshore banking really depends on the requirements they have, right? But this one just show you some of the benefits of offshore banking, right? It tend to give you better interest rate basically. But keep in mind that not everybody can get access to offshore banking because this bank, they only deal with large customers. They don't deal with small customers. Right? And you have to make sure that you can move your money there. Or if you borrow from them, you make sure that you can move money back home, right? Or move the money to where you want to invest, right? Right. So that's how the market look like, right? The next step, right? I want to talk about some instruments, right, that firm can use, right, to borrow money from this market, right? Apparently, there are two main ways that firms can borrow money from this market. Right? The first instrument is called Euro credit. Basically, that is bank loan. Right? The next instrument, go down, is to issue, right, commercial paper. Right? Commercial paper, basically that's promissory note, short-term debt instrument, right? So Euro commercial paper, that is ECP, right? Can you also change that to ECP? There's typing error there. That should be ECP. Okay. Let me explain how they work, right, briefly. I understand that you may have known this already, but let me complete my what I have to do, right, in case you don't know how they work, right? Let's start with bank loan. Okay. Bank loan in this market is known as Euro credit. Okay. So basically, this is when firm borrow Euro currency from bank, right? Offshore banks, basically. As I told you, right, banks in this market, when they lend money, they tend to lend in floating interest. That basically is because, right, lending floating interest, right, will allow them to manage interest rate mismatch better. Why do I say that? If you think about bank balance sheet, you know that 90% of the funding for banks come from taking deposit. Right? And then bank make loan, right, to make money. Deposit, remember that go to this bank, right, tend to be term deposit, but that term deposit tend to be less than 1 year. So that means the source of financing for banks, right, either that is onshore, offshore, it's the same. Deposit tend to be quite short term. So they get a lot of short term financing. But when they lend money, loan agreement tend to be longer than 1 year. Let's think about housing loan, right? So they tend to lend long term. So that creates maturity mismatch between financing source and the asset, right, that the bank invests. So one way there are so many risks involved in that mismatch, right? One of the risks is interest rate risk. So to reduce that interest rate risk that come from maturity mismatch, what bank in the euro currency market tend to do is that when they lend money, they tend to lend in floating interest term. Okay, that is to help the bank, right, manage interest rate risk. Now, if the loan is big, because we are talking about multinational corporations, so most likely when they borrow money, they want to borrow big amount. So when a single loan is big, right, banks might not be willing to take the risk. This is called counterparty risk. You have to understand that when banks lend money, they earn interest differential between deposit rate and lending rate. And that difference, right, could be 2 or 3%, right, of the principal amount. And they earn profit of 2 or 3% on the principal annually. But if the borrower default, that whole principal disappear. Right? So think about return that the bank can get and the risk that the bank faces. You can see that the risk is so much. Right? The borrower can default and the whole loan principal disappear, right, in the air. So banks normally have to manage customer concentration, right? They have to manage the concentration of their loan portfolio, not to have too much weight on a few borrowers. So if the loan is big, right, a bank, right, single bank might not be willing to lend. So in that case, right, banks might be willing to lend if a group of banks, right, come together and lend the money to one borrower. When that happens, right, we call that syndication. So if the loan amount is big, right, firms might have to borrow not from a single bank, right, but from a syndication of bank, a group of bank. So when the loan comes from a group of bank, that is called syndication loan. Now, to have syndication loan, there must be at least one bank who acts as the leader or the manager, right, of that whole syndication. So when it comes to syndication loan, right, there will be additional fee, right, that firm have to pay for that leading bank, right, to manage the syndication, right. So that will add upfront cost to the loan, right. And when we calculate the actual cost of capital for syndication loan, we must not forget to take into account the fee as well. Okay, so let me show you how to do that. Okay, let me show you how to do that. I will not go into detail. Okay, I just explain to you how to do the calculation. As for the calculation, you will go back and figure out by yourself, right? Here, right, I have IBM. Right, I want to borrow this amount for 2 years. Okay, so no single bank, right, willing to lend that much. Therefore, IBM must borrow, right, this in form of syndication loan. Assume that this syndication is led by Citibank. So to arrange this syndication, Citibank will charge an upfront fee of 2%. Right, whereby interest, right, is set to be 6-month LIBOR plus 1%. pay every 6 months. Okay. Now, what I want to do for this example is that I would like to calculate the effective interest rate, right? I want to know the effective interest rate that IBM, basically I want to know the actual interest that IBM have to pay on that loan. Now, since this is floating, so to get that actual rate that IBM have to pay on the loan throughout the 2 years period, I have to assume that 2 years has passed so that I know the exact interest rate during that period. Okay, so that's what I did here. So I assume that 2 years has passed, right? And what you see here is the interest rate on dollar LIBOR, right? At the beginning of each 6 months. Okay, that's the interest rate on 6-month LIBOR at the beginning of each 6 months. Okay, so with that information, right, I can construct the cash flows, right, that come from this loan for IBM, right? So that when we start, right, the first interest rate, right, in January 6%, and that is to be paid at the end of month 6, plus 1%, right, and so on. Okay. So in the second column here, that the interest rate being charged, right, to IBM. Now cash flows, right, at time 0, the loan principal is 100, but IBM will only receive 98% of that because there is 2% upfront fee. So that is the actual cash received. Now end of month 6, right, interest is 7%, right, half a year, that's 3.5. So 3.5 million negative cash outflow. Then you have 4 and so on. Notice that the interest payment from 7%, that 7% is applied to 100. Okay, not 98, right? That 7% had to be applied to the actual principal. But IBM actually received 98 to spend, right? But interest payment is based on 100. Last period, right? The principal has to be repaid as well. Now, if I want to know effective interest rate that the company have to pay for this loan throughout the 2 years period, I simply calculate IRR of that flows. Just calculate IRR from that flow. You will get 4.2% approximately, 4.2%. That is per 6 months, right? So if you want to do it per year, simply multiply by 2, simple compounding, 8.4% per year. Now, if you look at the interest rate that we have been using for this whole calculation, right? This is interest rates that we use for the calculation, right? You can see that none of that rate is more than 8%, right? The maximum is 8, but it can go to 6.5, right? 7 or 7.5, right? Depends on which 6 months you talk about. But in the end, right, I found that IBM pay effectively 8.4%, even though the interest rate that we use is less than 8% on average. And that is the effect of the upfront fee, 2%, right? But that upfront fee will be distributed, right, throughout the next 2 years, right? So when I want to compare, right, if I have more than one loan that I can borrow, so another bank might offer me with lower fee, but higher interest rate. For example, if another bank offer me, right, fee is 1%, but the interest that I have to pay is LIBOR plus, let's say, 75%, 3/4, 1%. So if another bank, right, compete with Citibank, right, and offer me this loan, now I have to compare, right, which loan, right, which loan we pay less. So to make that kind of comparison, you have to use this effective interest rate. Okay, because sometimes bank might offer you loan that has low interest, but they charge you more fee. And fee has quite big impact because that 2% you paid at the onset and you pay one, right? Or at once, right? At the onset. So it could have quite a big impact, right? On the actual cost of capital. So when we compare across loans, right? We have to use effective interest rate like this, okay? Right. Another way that firm can borrow money from this market is to issue promissory note or commercial paper. So in this market, that paper is called Euro commercial paper. Commercial paper is a short-term debt instrument. Right? This is the kind of debt instrument that do not pay interest to the holder. But the holder will buy this kind of instrument at a discount. In a way, right? Short-term debt instrument treat interest as subtraction. But when you borrow money from bank treat interest as addition. Let me explain this point a little bit because of the treatment of interest are different. That's why when you compare cost of borrowing between bank loan and this commercial paper, you need to convert number so that they are in the same footing. Right? And the reason why we have to convert is because they treat interest quite differently. Okay, let's think about bank loan. So let's say, right, the principal of the loan, right, is 100. Right, the interest is 5%. So if this is bank loan, right, borrower get 100 now and have to pay 100 plus 5 at the end of the loan period. But if this is short-term debt instrument, so the face value of the paper, is 100. The discount, right, is 5%. That means today, right, investor in the market will buy this commercial paper from the firm at 95. Basically, they subtract interest from the principal and pay the difference. And since interest is already subtracted at the beginning, therefore the repayment by the firm is just the principal. So that's how the treatment of interest payment is different, right, between bank loan. We treat interest as addition versus short-term debt instrument, where we treat interest as subtraction. Correct. You can think of that have the same effect. That's correct, Kun Atawun. It has the same effect as the fee, right? Paid upfront. That's correct. Okay. Now, because of this, right, you can't say that these two loans are the same in terms of cost of funding, right? Even though I use 5% on both type of loans, right? But you say that, right? The effective interest that the firm pay for the second one is higher than the first one. Because the first one, right, we pay 5 interest, right? On the actual principal that we receive, 100. But the second one, firm pay $5 interest on the actual money that the firm received, only 95. So effectively, this one is more expensive. So this one tries to tell you that when you want to compare the cost of borrowing between bank loan and issue short-term debt instruments, you can't use interest on the face, right, of the document to compare. You have to calculate effective interest rate or yield. You have to compare yield, right? I will show you how to do that in the next example, okay? Right. So since, right, the treatment of interest payment is quite different in this kind of borrowing, right? Therefore, I have to show you some example here. To make things simple, right, I will use simple day count convention. So one whole month, I treat as 30 days, right? One whole year, treat as 360, right? Okay, let's understand the instrument first. Right? Let's understand the convention in the market first, right? For interest comparison, I have another example for you, okay? So let's go back, page 31, right? This one, I just want you to understand the market convention first. Assume, right, PTT issue US dollar, Euro commercial paper, right? 6 months time to maturity. So when issue commercial paper, right, we have to determine, right, what would be the face value of this paper. So that face value is the principal, right, of this borrowing. So assume that the face value is $1,000 per unit. So that means those who hold this paper 6 months later can go to PTT, right? Give up the paper, and PTT will give back 1,000 US dollar. So the company will pay back the face value of the paper. So therefore, if I'm an investor and I want to invest in this paper, I must pay less than 1,000 today, right? So that I can earn something, right? When it is due. So assume that this paper is traded in the market at the market price of 980. So 980 is the market price in the market today. 1,000 is the face value. So that means if PTT sell this paper in the market today, PTT receive 980. At the end of the year, right? End of 6 months, PTT have to return the face value. That's 1,000. So that difference between the market price and the face value is called the discount. So this issue, right? This issue has a discount of 20 baht per unit. But normally we will quote the discount as discount rate, right? Percentage, right? So to turn that discount, right, in dollar term into percentage term, we simply take the discount amount, divide by the face value, okay? Divide by the face value, we get the discount rate. The market will call this as the discount rate. But in the market, when they quote discount rate, they will quote percentage per year. So you basically have to convert that, right, into per year. Since this is 6 months, so simply multiply by 2. Right? So the discount rate in this instrument is 4%. per year. Now, this part could be confusing because quoting price of commercial paper in the market, that is a convention. In Thailand, we do the same, right? That is a convention. And this is a convention that the market use when they quote price of a commercial paper. That is, quoted price is P. So quoted price will be equal to the face value minus discount rate. And the discount rate used in the quoted price is percentage per year. So that D must be percentage per year. And the face value used in the quotation is $100 face value. So basically the market will quote this right paper, right? The quoted price, right, will be quoted as quoted price per $100 of the face value. Quite confusing, right? So that means, right, since we know that PTT, right, Euro commercial paper has a discount rate of 4% per year, right? So that means in the market, when they quote this particular issue, right, they will quote as $96. So this will be quoted price in the market. That's $96 market price per $100 of the face value. So normally this is what you will see, right, in the newspaper, right, or in the quotation. So after you see that quoted price, right, you can convert back to 980. How do I convert that back into 980, right? Because I wouldn't see 980 in the quoted price, right? That one is a result of calculation, right? Quoted price is here. So from the quoted price, I know that the discount rate is 4% per year, right? From the quoted price, we know that discount rate is 4% per year. So that 4%, right, is for 100% face value, right? So if I start with the face value equal to $1, right, the discount is 4%. But that is 4% per year. So I have to make it into per period. Right? And then, actually another way to think about it is this. Okay, let me rewrite it, right? But the same result. If I start with $1 face value, okay, that's $1 face value. I know that the discount is 4, right? Because the price is 96. So if the price is 96, the discount must be 4. But that $4 discount is per $100 face value. But here I assume $1 face value first, right? So I have to divide that by 100 to make it per $1 face value. But still, that is a discount rate per year. Therefore, I have to adjust that to be per 6 months. Now, if I finish this calculation, that would be market price per $1 face value. But the actual face value is 1,000. So simply multiply by 1,000. Then we will get the actual market price, which is 980. 96 is quoted price. Okay, 980 is the actual money investor pay, right? That's market price. Okay, with this understanding of the convention, right? Let's go to the next example. This slide summarize all those calculations. I think you can come back to this by yourself, right? Just put everything from this slide into symbol only. Okay. Here, right, I would like to calculate the actual cost of borrowing for Exim Bank of Japan. So Exim Bank of Japan, right, issue commercial paper with a face value of 100,000 US dollar. Right? Time to maturity is 90 days, that's 3 months. And this issue is quoted in the market at this price. This is quoted price. So I want to know what is the effective borrowing interest rate for the Exim Bank. Because Exim Bank might be able to borrow the same amount from another bank, right? So Exim Bank want to know effective interest rate on this first to compare with another option and see which one is cheaper. Okay, so to do that, right, I start with the quoted price. So what I want next is I want the actual price, right? The actual money that Exim Bank will receive, right, from issuing this paper. So from the quoted price, right, I can get the discount rate. So from the discount rate, I can calculate the actual price, right? So that's 6.4 discount. That is per $100 face value. So from 6.4, I divide by 100. I get the discount rate per $1 face value. So deduct that from $1. But before I deduct, I should convert that discount rate, right, from per year into per 90 days first. And then deduct from $1. Then multiply by the actual principal, which is 100,000. So this would be the market price. So that means if Exim Bank issue this paper, right, it will receive 98,400 today. But at the end of month 3, right, Exim Bank, right, will have to repay 100,000. So basically the difference between that two amounts represents interest payment, right, which is called discount in this market. So that discount is interest payment. Now to calculate effective interest rate, right, I call that as yield. I simply take interest payment divided by the actual principal. Actual principal is 98,400, not 100,000. 100,000 is principal plus interest payment, right? So divide by the actual principal, then make it per year. So this is what I get. Then I can use this to compare with other loan options, right? Which one is cheaper? Okay, so that's how we calculate the effective interest, right, on this kind of borrowing. Right. Now, Euro bond. Okay, that's the end of Euro currency market. Right. The next step, right? I want to talk about bond market very quickly. Right. I want to talk about this market very quickly. Bond market. Bond market is part of financial market. Right. In financial market, we have debt, right, and equity instruments. Right. So this is about debt instrument, bond market. International bond market. International bond market can be divided into two sections. One is called Eurobond. Another one is called foreign bond. So if a company would like to get access to international bond market, this is mainly long-term financing, right? If they want to get access to international bond market, right? There are two options. Either issue the bond as Eurobond or issue the bond as foreign bond. So what I have to do is to explain to you the differences between these two, right? And their advantages and disadvantages so that you can compare, right? When to use Eurobond, when to use foreign bond, right? Okay, let me first classify bond market. Bond market can be classified into two sections, right? Domestic bond markets and international bond market, right? And in that international bond, right, you can further classify into foreign and Eurobond. Okay, so there are three bond markets there that I need to explain to you, right? So what I want to do next, right, is to explain first what is domestic bond, what is foreign bond, and what is Eurobond, right? You need to understand their differences first, right? So let's start with a domestic bond, okay? A domestic bond, right? This is the bond issued by local corporation or local government, right? And underwritten by a syndicate, right? By a group of domestic investment banks, denominated in local or home currency, right? And then issue, right, to be sold to domestic investor, right, in the domestic market. So this is domestic bond. Everything domestic, basically, right? For example, PTT, which is a Thai firm, issue Thai baht bond, home currency, and then sell this bond, right, in the Thai market. So this is an example of a domestic bond, right? A local corporation issue home currency denominated bond and then sell that bond in domestic bond market, right? That's domestic bond. A foreign bond market or a foreign bond. This is similar to domestic bond, except, right? This bond is similar to domestic bond, except that the issuer of this bond is a foreign company or foreign government. You might not know, or you might be surprised to know that in Thailand, we have domestic bond market and also foreign bond market. Even in Thailand, we have this one. It's just that this foreign bond market in Thailand is very tiny, probably less than 0.5% of the whole bond market in Thailand. So about 99.9, 99.5% of the bond market in Thailand is domestic bond. But we also have a tiny part of our bond market which belong to foreign bond section. Let me give you an example of a foreign bond in Thailand. In the past, ADB, not sure whether you know ADB, Asian Development Bank, right? If I'm not wrong, this one is from Japan, right? Asian Development Bank. So that organization, right, is foreign entity to Thailand, right? So in the past, right, ADB used to issue Thai baht bond, right? They issue Thai baht bond, right? Sell to Thai investor. Why do they want to get Thai baht, right? Because they re-lend the money, right, to an entity in Thailand, right, who borrowed the money to do some projects. So since the borrower is in Thailand and want to borrow Thai baht, but they want to borrow from ADB. So when ADB raise fund, better raise Thai baht, right, and re-lend the money to the Thai entity. So, but ADB is not a Thai entity. Therefore, the bond issued by ADB must be considered foreign bond in Thailand. Not many years back, a firm from Laos that sell electricity also issue bond in Thailand, issue Thai baht bond, right, and sell the bond for Thai investor in Thailand, right? But that firm is a Laos company, right, and electricity company, right, electricity generating company, right, issue Thai baht bond, sell to Thai investor, but the company, the issuer himself or herself is not a Thai firm. Therefore, that is also a foreign bond in Thailand. So we also have foreign bond section in Thailand, but it's very tiny. And think about it, it's Thai baht. Not many firms, right, outside in this region, well, we need to use Thai baht, right, for that investment. So the biggest foreign bond market in the world is in the USA. The biggest foreign bond market in the world is in the USA, right? I explain about that later, right? Now, since this bond, right, is issued by foreign entity, but to be sold to domestic investor, therefore, this bond must be issued under the regulation of the country where the bond is issued. Right? So basically, this bond must be under the regulation of the country where the bond is issued. So the issuer must submit, right, filing, right, must submit request, right, to the domestic SEC, right, the Security and Exchange Commission, right, to issue the bond. And normally the SEC will require the issuer to get credit rating for the bond, right? This is to basically protect, right, domestic investor, right? So rating is normally required. Sometimes, right, when a lot of foreign firms want to issue foreign bond in a country, that will result in, right, competition, right, to domestic corporation who also want to raise money. So foreign bond can actually be competing with domestic bond, right, for the money. So in that case, right, it can potentially cause the cost of funding to the domestic firm to go up because there is more firms now want to compete for the same pool of money. Sometimes the local regulator might want to protect corporate, right, in the country, right, not to have so high cost of capital, right. Then sometimes they might have a quota system, right. They have a target of what would be the maximum amount of foreign bonds to be issued in certain years. And if the demand to issue exceed that threshold, then foreign corporations have to wait for next year. So queuing system might be required or applied for foreign bond in some countries. So submitting the request, right, to domestic regulator takes time. Queuing system will cause this kind of issue to take even longer, right? Take even longer before the firm can actually get the money. Right? Credit rating also takes time, right? So normally to issue foreign bond, the process will be a bit longer, right, than the next one, which is called Eurobond. Before I explain what Eurobond is, I forgot to tell you something. Just go back one slide. Foreign bond, right, and foreign bond market tend to have a nickname. If Thai government want to raise US dollar, so want to issue US dollar bond. Now the Thai government right, want to issue US dollar denominated bond, I guess if the Thai government want to sell this bond, the Thai government might think about US market first. So in that case, the Thai government must get access to the foreign bond in US market. So this is a bond issued by Thai government, which is a foreign entity, right, from the perspective of the USA, right? But this bond is issued in US dollar, which is a home currency to USA, right? So to US investor in US market. So this is the US foreign bond market. The nickname of the US foreign bond market is Yankee bond market. Right? And the foreign bond in US bond market is known as Yankee bond. So if the Thai government sell that bond in US market, that will be counted as part of the Yankee bond market. Okay. Foreign bond market in the UK, right, is known as Bulldog bond. Foreign bond in Japan, that is called Samurai bond, and so on. Right? They tend to have nickname. Okay. Eurobond. Okay. When it comes to Eurobond, this is a bond that is issued and traded in different countries simultaneously. So this is a bond that after issue, right, the issuer sell that bond, right, in more than one market, more than one country simultaneously. So when it comes to Eurobond, right, we have to hire, right, an underwriter that has international connection, right? Unlike domestic bond and foreign bond, when we use domestic investment bank as the underwriter. But when it comes to Eurobond, you need to use international investment bank because they would have international connection to place this bond, right, to investors in various countries all at once. So the fee involved, underwriting fee for this kind of bond is normally high compared to the first two. Because here you need somebody that has connection. And that connection has price, basically. Right? That connection means the underwriter, the lead underwriter, would have to form a syndication of underwriter, right? And then help you to sell it. So the fee can be quite high in this kind of issues, right? And since, right, we sell this bond in many countries at the same time, therefore, most likely the currency of denomination of this bond would be foreign currency to those countries that you sell the bond to. For example, K-Bank. K-Bank used to issue Eurobond in the past. But I think those bonds has already expired, matured. K-Bank, right, might want to raise US dollar funding. So K-Bank issue dollar bond. Now to sell this bond, there are two options. I think sell this bond in Thailand will not make that much sense because in Thai market, we mainly use Thai baht, right? Dollar is quite illiquid, right, in Thailand. So two options, I guess. That is to go to Yankee bond market. Right, that is foreign bond in US market, or sell it as Eurobond. Eurobond might be attractive because when it comes to Eurobond, countries normally treat Eurobond, right, as private placement, Basically, Eurobond, right? When firms want to sell Eurobond, they tend to sell this bond to high net worth individual or institutional investors, not to retail. So this bond is normally sold to high net worth or institutional investor. So domestic regulator normally treat these investors as being sophisticated, doesn't require much protection. Therefore, requirements, right, to issue this kind of bond is quite minimal compared to if you want to sell bond to retail investor. So the attractiveness of Eurobond is that regulation, right, regulatory requirements, right, is quite minimal. So the issue can be quite quick, right, and you sell in different markets at the same time. You get access to bigger pool of investor. Unlike Yankee bond, you go to one market, you have to subject to a lot of regulation there because US lawmaker also want to protect, right, domestic investor, right? So Eurobond might be attractive in this case, right? So if KBank want to sell that as Eurobond, KBank would have to contact investment bank, right? That is an international investment bank, right? To sell that issue. And since this is private placement, therefore credit rating is not required. Non-rate, you can sell it as non-rate. Probably non-rate bond become more and more popular in Thailand recently. I don't know why, but that could be quite dangerous. You know, right? In the US, there was a period where junk bond became so popular until at one point the market collapsed. Right? I found that these few years, right, non-rated bond become more and more popular. I mean, a lot of firms issue non-rated bond. People dare to take more risks. This is called search for yield, I guess, right? Because our interest rate has been kept low for so long, right? So people now dare to take more and more risk. Anyway, Eurobond, right? Rating is not required. However, in actual practice, right, to sell easier, firms normally do the credit rating. Right? That is just to help the issues to be sold easier, right, than without the rate. Okay. This is the size of the market. You can see that, right, domestic bond market is still the biggest part of the global bond market. International bond market is about 30%. But you can see that the proportion of international bond market, right, to the overall market, right, become bigger and bigger, right, in terms of proportion, right? So basically that means firms, right, including investors, I guess, right, they are more advantageous, right, in terms of their investment. In that international bond market, the biggest part of that belong to Eurobond. So basically, in the international bond market, right, about 20% belong to the Eurobond. 80%, sorry, belong to the Eurobond. 20% belong to the foreign bond markets. Okay. That's how the market composition looks like. Decal convention. We come to this when we come back. Okay, let's go for a short break. This is 10:30, right? Let's go for a short break. When we come back, I will show you how to calculate effective interest rate on bond, right? And talk about this Decal convention. Even though throughout the course, I will use this convention, right? But I think you need to know, right? When I keep saying this term many times without explaining to you, right? Day count convention. Okay. When we come back, I explain that to you. Right? Okay, in the exam, you don't have to worry about the count convention. Okay, in the exam, I will not ask anything about this at all, right? But I think it's a good knowledge to have, right? Normally in financial market, right, when financial institution quote interest rate, whether it is loan or deposit, right, they will quote interest rate as say X% per year, right? But the time, right, the period of the loan or the period of interest calculation might not be exactly 1 year, right? So you have interest period that you have to deal with. Interest period refer to the period for the interest payment. A day count convention. Day count convention will specify, right, how the number of days during the interest period will be calculated, and that will affect the actual interest payment. Furthermore, right, we quote per year, but we know that each year, right, the length of each year in terms of number of days in each year is different, right, depending on whether in February of that year there are 28 or 29 days, right? So the number of days in each year is also different, right? Depends on the year you are in, right? Therefore, day count convention will also specify, right? How do we count the length of 1 year? So basically how the length of interest period is calculated and the length of 1 year is calculated will be specified in the day count convention that we use. Apparently there are 4 day count conventions that are mainly used in practice. There is another convention as well that I ignore from this slide, right? That one's a bit more complicated to do, right? But these are the most popular day count conventions in operation nowadays, right? The first part of the convention will tell us how do we measure the length of an interest period. The second part of the convention will tell us how do we measure the length of 1 year. So actual means count the actual number of days during the interest period and use that actual number of days, right? The second actual means, right, 1 year, the length of 1 year, use the actual length. So the actual number of days in that year. This is called actual. Now, if the day count convention is actual, 365, that means the interest period used the actual length, but in 1 year, take it as 365 days per year, regardless of whether in that year, right, there are 365 or 366. Always use 1 year equal to 365. This is a day count convention we use in Thai financial market. Another day count convention that is also popular in certain market, right, is actual 360, meaning that the length of interest period use actual length, actual number of days, but per year That means 1 year is equal to 360 days. This is the kind of convention that is used for US dollar. Offshore, onshore market, they use that convention. The last one is the one we use in the lecture just to make life simple. If the interest period, right, is a whole month, count that as 30 days. So if the period is a whole 3 months, count that as 90 days, right? 1 year, count as 360 days. So these are the 4 popular day count convention. Now let me show you how day count convention can affect the actual interest payment. Assume a coupon bond, right? Face value is 10 million, right? Coupon rate 5.5% per year. Now I assume that this bond pay coupon on a monthly basis every month. Now I want to calculate interest payment in February. And assume that in that particular February, there are 28 days. Okay? So that means in that year, in that particular year, there are 365 days. That's actual number of days per year, right? Now, if this bond, right, use actual day count convention, the meaning is this: that 5.5% per year means 5.5% per 365 days, actual number of days per year, right? So if I start with 5.5% divide by actual number of days per year, I get interest rate per day. Then in that period, there are 28 days. So multiply by 28 to make it per period. Then multiply by the actual principal. So this is interest payment. Right? Of course, this will be equal to the next convention, which is actual 365. Because in that year, the actual number of days per year happen to be equal to 365. So these 2 conventions, right, in this example, give the same interest payment. However, if the convention is actual 360, the meaning is that 5.5% per year is actually 5.5% per 360 days. So if I start with 5.5%, divide by the number of days per year, which is 360. So divide by 360. That would be interest rate per day from the quotation. Then multiply by the actual number of days per period, which is 28 days. That will be rate per period. Then multiply by 10 million. So you can see that these conventions give us more payment. I mean, for investor, they would be happy, right? But for the firm, this is more expensive, right? 5.5%. But if the convention is actual 360, the actual payment is actually more than the first 2 conventions. But if the convention is 30, 360, the payment is actually even higher, right, for this particular month, right? Because we have to assume that that whole month is 30 days. So resulting in a longer period and higher payment. So this one shows you that day count convention affect, right, the final payment. So that means if you are comparing 2 sources of fund that first are not in the same currency, Second, use different day count conventions, or comparison could be quite complicated, right? Not only you have to convert the currency, you also have to take into account the day count convention. Okay, that's something you have to think about, right, when you calculate cost of capital. Okay, but as I mentioned earlier, in this subject, I will not ask you anything about day count convention, right? Okay, that's the day count convention. Next, right, as I mentioned earlier, when firms, right, want to get access to international bond markets, because sometimes Thai firms might want to borrow US dollar. So if a Thai firm want to borrow US dollar, let's say long term, so using bank loan might not be good in some situation, because borrow long term bank loan, right, in euro currency market, most likely the bank will charge floating interest rate, but the firm might want to pay fixed, right? So floating rate might not be suitable. So if the firm want to borrow long term and pay fixed interest rate, then issuing bond might be the option, right? But the firm want to issue dollar bond, therefore using Thai market might not be appropriate. So have to go to international bond market. There are two options, right? Go to Yankee bond market or issue it as Euro bond. So what I try to do here is that I try to compare pros and cons, right? Good and bad, right? Between these two options, okay? So I want to compare basically foreign bond, okay, versus Euro bond, right? Mainly, I want to compare these two. Whatever I am going to say, right, that is a summary in this table, right? This table summarizes various aspects of different bond market, okay? Here you have Euro bond market. Here, that is domestic and foreign bond market in the US. And this is Euro bond market. The one in the middle refer to domestic and foreign bond market outside USA, right? So if I want to compare between Yankee bond and Euro bond, I use the first and the last column, right, for comparison. Okay. First, right, Euro bond market tend to be subject to less stringent regulation, and disclosure requirement will also be less stringent compared to foreign bond, because countries normally only allow Euro bond, right, to be sold privately, right, not to the public, right, only high net worth and institutional investor will get access to this kind of bond. Therefore, they need, right, as sophisticated investor, they need less protection from the regulator. So that results in less regulation, less disclosure requirement. So that means Eurobond will incur less of this kind of cost, right? Furthermore, because we don't have to go through a lot of filing requirements, right, in Eurobond compared to foreign bond. Therefore, Eurobond issuance, right, tend to take less time to complete, right? So if you look for speed, you want to get the money quickly, Eurobond would be more appropriate, right? Because foreign bond take longer time. Furthermore, right, to do foreign bond, right, you have to do rating first, right, before you can issue. So that take even longer time, right? However, in Eurobond, the upfront fee, right, the issuing cost, right, tend to be higher. But when it comes to features in the bond, right, types of bond, we find that foreign bond tend to have more variety than Euro bond, Eurobond, right? Eurobond tend to have more varieties of bond, right, compared to foreign bond. Basically, when firms issue Eurobond, right, they tend to put more features in the bond to suit the investor they want to attract. But foreign bond tend to be more plain vanilla, right? Not much feature. Eurobond can be issued, right, in the form of bearer form bond. To understand this point, right, let me explain a little bit. When firms issue financial securities, right, or financial assets, basically, let's think about financial assets. Financial assets, right, can be issued in bearer form. Or registered form. The best way to think about these two is if you think about banknote that is also financial assets issued by the central bank, right? Banknote is also financial assets issued by central bank. Banknote is issued in bearer form, meaning that there is no name of the owner of that asset, right, registered anywhere. So whoever hold that is the owner of that money. That is called bearer form. You can think of bank check. If I write bank check, right, I normally have to put the name, right, of the person that I instruct. Right, let's say bank check is an instruction, right? Bank check is actually an instruction. Basically, if I write a check, I am instructing my bank to make payment, right, to a third party. And the party who received the benefit from this check is where I have to put their names in. But I have a choice not to put name, but say bearer. That means if I don't put the name, I just put bearer. That means whoever holds this check can always withdraw the money. But if I put name and cross bearer behind that space, that there will be a word called bearer. If I cross that and put the name instead, that means only the person with that name can withdraw money using this check. So if I put the name onto that check, right, that is called registered form. But if I don't put the name, then that will be bearer form. So financial assets, right, can be issued, right, as bearer form or registered form. Domestic bond, right, bond that is issued under the local regulations is normally issued in registered form, meaning that the name of the bond owner is registered officially. So there will be names of the owner on the bond. And if you want to sell the bond before maturity, you have to flip to the back side of the bond and then sign your name, right, to transfer the ownership of that bond to another person. Bank check can be done the same. If you flip over bank check, it can be also transferred. It's just that, right, that the name of the owner is always registered officially. So in that case, right, when bond pay coupon, it becomes quite easy for the Internal Revenue Service, right, to follow who received that interest, because interest income is subject to income tax. So when the bond is in registered form, right? It is easier for the internal income service, right, to track who received that interest payment and then trace them to pay tax. Eurobond is different. Eurobond is normally issued in barrel form. Barrel form means there is no name of the owner registered. So it is quite hard to track who is the eventual owner of the bond. Right? Quite hard to track because there is no name registered on it. So at the time of coupon payment, basically in the past, this is how they do it, but I'm not sure nowadays how they do it. But in the past, right, this bond, we have a ticket. Right? If you hold this bond and it is time to receive the coupon, you simply tear that ticket, tear that one off, and go to the financial institutions that you get the name, right? And then you can withdraw that coupon, right? And this become harder for the internal income service, right, or internal revenue service to track, right, who received the coupon. And that means the person who received the coupon can avoid tax easier, right, than if it is in registered form. So somebody said that, right? Somebody said that because of this, people who invest in Eurobond tend to require a little bit less return than investor investing in foreign bond, because in Eurobond they can avoid tax. In foreign bond they can't. So if they can avoid tax, they will demand a little bit less return, right, from the firm. So that allows the firm to have a little bit less cost of capital compared to foreign bond. Okay, and that will be benefit to the firm, right? The last one is from observation that, right, some researcher has observed that on average, the time to maturity of Eurobonds tend to be shorter than the time to maturity of foreign bond. So that might imply that investor in Eurobond market, they prefer medium and short-term bond rather than very long-term bond. So if you want to issue very long-term bond, right, the chance of success in Eurobond might be less than foreign bond, right, for example. Okay, so these are features, right, pros and cons that firms can use, right, when they have to make choice, right, where to go. Okay. This last example, right, about, actually I have two examples, I think, one, two. I want you to do these two examples by yourself. The first example, right, I want to show you how to calculate effective interest rate that firms have to pay, right, when they issue bond. In this example, I assume, let's see, I assume Eurobond, right? That means higher upfront, right? A little bit lower coupon rate, right? And the interest payment in this example is once a year. Now, if you go down to another example, in this example, right, I asked you to continue from the previous example. So apparently PTT has another choice, right? PTT has another choice. Rather than issuing that bond in Eurobond market, PTT can issue the same bond, but as a Yankee bond in US market. But this bond, right, will incur a little bit higher coupon rate, right? Eurobond, if you go back up 2 slides, 7.5. Yankee bond, 7.6. Because yield on Yankee bond tend to be a little bit higher, right? However, the upfront fee is lower. Furthermore, interest payment in this, right, is on a semi-annual basis. So basically, I want you to compare which bond is cheaper to issue from the perspective of PTT. So your task in these two examples is that you have to calculate effective interest rate and then make comparison. And the way to calculate effective interest rate is to first draw cash flows from the bond. And then from the series of cash flows, right, you then calculate IRR from the bond. Okay, let me go back to the first example. This one, right, the Euro bond. So from this information, right, I construct cash flows. And from the cash flow, I calculate IRR. So that would be effective interest rate. Even though coupon rate is 7.5%. But the actual rate that this PTT has to pay for this bond, right, is actually 8%, not 7.5, because you have to take into account the upfront fee as well, right? That's the upfront fee, right? So that's the rate. Now, second example, Yankee bond. This bond, right, you have to pay interest every 6 months. So my table become longer, even though it's the same 5 years, right? But this one, each period is a half a year. So construct cash flows, then calculate IRR. Now this IRR, you cannot use straight away because that is per 6 months. So if I want to compare this with the previous table, I must put that into per year. So I have to convert percent per 6 months into per year first. Once I get that, I can compare 8.13% with 8% to see that this one is actually cheaper, right? Cheaper by 0.13%, which is not a lot, right? Which is not a lot. So that means if the difference is not that much, then you have to consider other feature of the bond, right? Well, which one you prefer in terms of other features, right? For example, this one only pay interest once a year. So you don't have to pay so often, right? But the other one, you have to pay every 6 months. So the chance of liquidity risk of this one could be higher, right? Because you pay more often, right? But this one you pay less often, right? But bigger amount. But at least you have longer time to prepare, right? For each period. Okay. Right. That's what I want to talk about. Now, last one. Equity market. International equity market. When it comes to equity market, apparently each country will have their own equity market. So equity market tend to be national market. Equity market tend to be national equity market. So if firms, right, want to have its stock, basically if firm want to get access to foreign equity market, right, it has to list the stock in foreign exchange. So when a firm lists stock in an exchange outside its own country, right, that is called cross-listing. Apparently, cross-listing is not the only way that firm can get access to foreign equity market. Right? There is another way that might be cheaper, but the access might not be as full as cross-listing. That is to get access in the form of depository receipt. So what I want to do next, right, is to explain to you basically, mainly I want to explain this one, depository receipt. That could be a new instrument for you, right? Okay, let me start a little bit about equity market. Basically, there is really no international equity market. If you want your stock to be traded in Singapore, you have to list your stock in Singapore market first. Right? In Europe, there are some national markets that coordinate. So a company can list its stock in more than one national market and then have their stock trade across these different markets. But still, right, we still have to list the stock in the market we want it to be traded, right? So in the end, right, equity market is mainly national market, right? So there's no market that is like Eurobond market, right? There's nothing like Euro equity market, right? So countries normally have their own, right, equity market. And if companies, right, want its stock to be traded in that market, then just have to register, have to list with the market first. And to list stock in market, right, we have to, as a company, right, we have to pass certain requirements. And these requirements will be different in different markets. And normally, if the market is in developed countries, requirements tend to be more stringent because they protect retail investor. And requirements might be less restrictive, right, in the market that is not developed or small market. And some of these markets allow foreign firms, right, foreign stocks to be listed. And if the market allows foreign stock to be listed, then that market open opportunity, right, for foreign firm to raise fund in their own country. Now, company, right, foreign firms can get access, right? They can get access to foreign equity market, right, in two ways. First is to have the stock to be traded in foreign market directly. This is what I call cross-listing. Another way is to have its stock to be traded in foreign market in the form of depository receipt. Okay, so we go to that. Let's start with cross-listing, right? Cross-listing is a transaction where company, right, from one country, right, have its stock to be listed in an exchange, right, of another country. Could be one or more than one countries, right? Depends. In Thailand, right? I should not say Thailand. I should say a Thai firm, right? In the past, right, there are some Thai firms that have its stock listed on foreign exchange. I think the latest one that I can remember would be Thai Bev, right? Thai Beverage, which is a Thai firm. But the stock of Thai Beverage is not listed in Thailand. The stock of Thai Beverage is listed on the Singapore Stock Exchange. So that is cross-listing. So that allows Thai firms, right, to get access to Singapore capital market. Normally, the target market for foreign corporation to cross-list, right, will be developed market. Because if a firm want to cross-list its stock in another, in foreign equity market, of course, they want to get access to bigger pool of fund, right? They want to get access to more varieties of investors, right? So that is why, right, the capital market of developed countries tend to be targets where foreign firms would like to have their stocks to be cross-listed. And the US is the most popular destination for this kind of transaction. So if you go to the next slide, right, this one show you the list of stock exchanges, right? And let me remove this, something stuck my visual. Okay. This is the total number of firms, right, listed in the exchange, right? And decompose into domestic firm and foreign firm. So you can see, in the US, there are more than one exchange, right? In the US, there are many exchanges. So these two, right, at least that two belong to the US. So you can see that USA, right, is quite a popular destination for foreign firms, right, to have its stock listed, right? The reason being that US stock market is the biggest in the world, so that market has bigger pool of fund. So if we want to raise big amount of money, right, we will not squeeze the market because the market is a lot bigger than the demand for capital by a company. But if you think about a firm like Nestle, which is a very big company, right, from Switzerland. So if Nestle want to issue equity, right, to invest in big scale. So if Nestle only relied on Swiss market, right, which is quite small, right, compared to the size of the company. So when Nestle issue equity to sell in Swiss market, most likely that demand for capital by a single firm will squeeze the whole market, meaning that draw a lot of capital from the market. And Nestle have to compete with other firms in the market as well. So in the end, Nestle end up paying more. They have to attract investors to buy Nestle stock. They have to pay more return. Basically, that increase the cost of capital. But if Nestle can get access to US market, that market has a lot bigger pool of fund. So the demand for capital by a single firm like Nestle will less likely squeeze the market in the US. And therefore, the company doesn't have to improve return, right, to investor, and therefore doesn't have to pay high cost of capital. This is one of the reasons why firms prefer to list in bigger market, deeper market, right, and where there are varieties of investors involved, right? Okay. In this slide, I try to summarize to you for you, right, the reasons why firms might want to cross-list its stock. Okay, there are a variety of reasons. Of course, the very first reason would be to overcome mispricing. Because big company in a small country, when they raise funds, right, they tend to squeeze the market and therefore increase the cost of capital. Right? And since markets are segmented, right, so if you are from small market and if the market is not liquid, most likely the cost of capital in home country could be higher than in foreign countries. So getting access to bigger market will has a potential to reduce cost of capital. Another reason that has been cited by companies why they want to cross-list is that they would like spotlight in that market. Right, so normally cross-list, right, being listed, right, can improve status of a company, right? Normally investors look at listed firm as having better, say, governance standard, right, than non-listed firm, because to be listed, we have to pass certain requirements, right, by the authority. So sometimes firms want to cross-list because they want to get political acceptance, right, in that particular country, which could allow them to get better names, right, better reputation, and that could help them in other strategy like marketing, for example. Firms might want to cross-list because they would like to raise funds in that countries in the future. So use that capital market as the base, right, to raise funds, say for buying another company in that country. And that actually happened with Thai Bev, right? After 4 or 5 years, right, of listing in Singapore market, right? Later on, Thai Bev, right, use Singapore market as the base for capital, and then take over another beverage company called F&N, right? That's also another listed firm in Singapore, right? The last one, that's also reasons that has been cited, that sometimes they want to cross list because they want to establish secondary market for the stock, and so that they can use that, right, as a way to compensate local manager, right, local CEO, right, basically pay stock option, right? So if you want to give stock option to the local CEO, right, then the stock have to be listed in the local exchange first, right? So these are reasons, right, why firms, right, might want to cross list. However, cross list, right, is not the answer for all the firms that want to get access to foreign market. Being that, right, the reason being that upfront fee could be quite high, especially if you want to list, right, in, say, New York Stock Exchange, right? The upfront fee could be quite high. Furthermore, you also have to pay annual listing fee as well. And if you want to cross list, right, in the market that is more developed, right, they would have different standards of disclosure requirement. So to cross list, sometimes we have to reveal more information than what we used to. So to some firm, right, revealing of information is costly, right? And if the accounting standard that we use in home country is different from the country that we want to cross list, we also have to revise our accounting practice, and sometimes have to redo, right, backward, right, 3 or 4 years back. So this adds up into the cost, right, to cross list. Furthermore, right, if your stock is not actively traded, right, the listed status, right, can also be canceled, right, if they after listing, right, the trade is not active at all, right? So you have to make sure also, right, that after we list the stock, right, there's some liquidity, right, for the stock to be traded. Furthermore, right, we have to commit to the investor relation activities, right, and these all add up into cost of cross listing. So therefore, right, this is not the answer for all the firms. So if cross list is too expensive, but firms still want to get access to foreign investor, what else can be done? So this is another option called depository receipt. In case you don't know what it is, right, let me explain first, right, what is DR? And the market, right, the biggest market for this instrument, right, is in the US. So when I explain DR, later I will use American depository receipts as my example, okay? But there are DRs in other countries as well. It's just that the US happen to be the biggest market for this kind of transaction. DR, right? Basically, this is negotiable certificates issued by financial institutions. It is certificate that is tradable, right? Issued by financial institutions. This certificate represent, right? This certificate represent ownership of the underlying stock, right? Whereby the stock, right, is held at a custodian bank. So this certificate basically, right, represent, right, if you hold this certificate, that means you own underlying stock, that is held at a custodian bank. When you think about DR, I think if you're not used to this, right, think about this, think about land. Let's say you have a piece of land. You can't move it. So the piece of land stay in one place. You can't move the land, right? Now, if I want, first, how do we represent ownership of the land? How do we represent ownership of the land? It is the land, the Department of Land, right? It is the Department of Land that issue land deed. So this is a document, land deed. You can think of DR as land deed. Basically, land deed is a document, right? Is a document, right? That is issued by an authority, and this document represents ownership of that piece of land. In DR case, right? That land is a stock. But this stock is held at a custodian bank, right, or a deposit institution that provide, right, depository service, right, and then we write another document called DR, normally issued by financial institutions, and that DR represents ownership of that stock. I will explain later why we have to do that, okay? But go back to the land. Now, if I want to sell land, I simply sell that land deed. Basically, if you flip the land deed right behind, I can transfer the ownership of the land to anybody I want. So if I sign and that person receive it, then the ownership of the land change hand, but the land is still there in the same place. Ownership change through buying and selling that deed. Same thing apply here. Why do we have to do DR? Why don't investors buy and sell PTT stock directly? Okay, don't forget, this is a Thai stock. Right, but this DR could be created in the US called ADR. So that stock, right, is created under the Thai law. So all the documents involved is in Thai language mainly, right? So if investors want to buy and sell PTT stock in the US, it's quite difficult, right? Because of first, the instrument itself is created under the Thai law. Second, the currency of denomination, the par value, everything is in Thai baht, Thai language. So it might be easier that a financial institution in the US create another document, right, that is supported by the US law called ADR. And that document represents the ownership of that stock. So put a stock in one place, right, that we can trust. And then issue ADR and sell that ADR. So now investors in the US can buy and sell ADR as if they are buying and selling PTT stock. And this is the idea behind this, right? And it is a lot easier to buy and sell ADR because that ADR is written under US law. Currency of denomination of the ADR is US dollar. So they don't have to involve with foreign currency at all, right? So that becomes easier. So from the US side, right, from the investor in the market that the depository receipt is created, right? That allow investor to get access to foreign investment, to foreign stock, foreign company. As for the Thai firm, ADR also give them access to US investor. So this is like win-win, right, situation. And this kind of instrument, right, start to pick up its popularity after the collapse of the Bretton Woods. Because after the collapse of the Bretton Woods, 1973, remember, developed countries start to lift up capital control. They start to lift up their capital control, right, after the collapse of Bretton Woods. So once capital control is lifted up, investor now can get access to foreign investment. So demand for foreign securities start to pick up after that. However, if US investor want to buy Japanese share, it's very difficult. They have to open account with Japanese brokerage firms. Any company analysis, right, written by analysts will be in Japanese language. So they want to invest, right? Investor, let's say in the US, want to invest in foreign stock, but it is very difficult for them, even though the law allow them to do so, still difficult, right? This is when, right, financial institutions in the US see the opportunity that they can create this kind of instruments and then sell to US investor, create this market, and then they get fees, right, from this service. Okay, right. So that's background. So let me go back to the lecture note. So let me repeat that. Depository receipt, right? This is a negotiable certificate mainly issued by financial institutions, right? That represent ownership of the underlying stock, right? So the biggest market is in the US. DR in the US, right, is called American Depository Receipt, right? So I'm going to use this as an example, right, throughout. So this is a certificate, right, that is issued, right, and traded under the US law in USA and denominated in US dollar. So if financial institutions, right, want to create ADR, it must be created by US financial institutions. So if US financial institutions want to create ADR, right, they have to get approval from the US SEC first, right? Now, to create ADR, right, financial institutions have to apply, right, with the SEC, right? Apparently, there are different types of ADR that can be applied for, right? There are different types of ADR programs that financial institutions, right, can apply for. These various ADR programs, right, they are different, right, in two perspectives, right? They are different into, I should say, aspects, right? There are two aspects, right, that make ADR program, right, to differ from each other. The first aspect is, right, whether the ADR is sponsored or unsponsored. Sponsored ADR, right, refer to ADR that is created upon the request of the foreign firm that issue the foreign stock. So if it is the foreign firm, right, that is the one that issue the stock, right, request, right, US financial institutions to create ADR, then this is called sponsored ADR. But US financial institutions can also create ADR without a request from the foreign firms. Basically, go to foreign stock market, buy the stock in the exchange, right? And then create ADR to represent ownership of that stock that just purchased. In this case, right, this is called unsponsored ADR. The difference between these two mainly is the commitment that we get, right, from the firm. Because if the ADR, right, is sponsored, right, it would imply that the foreign firm would have more commitment, right, to get involved with this issuance. But if the issue is unsponsored, that means U.S. financial institutions issue ADR without a commitment, right, to cooperate, right, by the foreign firms. Okay, that's first aspect that make ADR programs different, right, from one to another. Another aspect that caused each program to be different is the level of certification or the level of commitment. Basically, the second aspect means that whether this ADR, right, can get access to just OTC market, or whether the ADR can get access from exchange market, right? And in the exchange market, it can be secondary market or primary market. So different ADR programs, right, will get permission, right, to the market, right, differently. So a program, right, allowed by the SEC might allow this ADR to only get access in the OTC market. So basically, the ADR can be traded only in the OTC market. Another program might allow ADR to be traded on exchange. Another one might allow the ADR to sell in the primary market as well. So different programs would have different level of access, right, to market. So this is the second aspect. And these two aspects, right, result in different level of ADR programs. This is an example of the US market. Okay. So if the firm, right, if the financial institutions apply for ADR level 1, that means this ADR can only be traded in the OTC market. But if the financial institution would like this ADR to be traded on an exchange, then it has to apply for either level 1 or level 2. Level 2 or level 3. However, level 2, right, only allow the ADR originator to get access to secondary market. Right? Level 3 will allow the firms, right, to get access to primary market as well. So if the firm want to issue new stock, right, and then create ADR over that new stock to raise new capital, in that case, you have to apply for level 3. But if we just use stock in the secondary market, right, and then write ADR on top of it and sell in the US, in that case, level 2 would be sufficient. So these different programs, right, are different in if you go back one slide, these two aspects. Okay. Now, what I want to show you next, right, is I want to show you how ADR can be created first. And next, right, I want to show you that even though US investor trade ADR under US dollar, but ADR will expose US investor to exchange rate risk. So even though this is denominated in US dollar under US law, but the instrument itself will expose US investor to foreign exchange rate risk because it is still considered foreign asset, right? Let me show you that, right? To show you what I claimed just now, right? I can actually use this diagram, but I found that this diagram is a bit more complicated, and if I use this one, I take more time to explain. So what I have done is that I have created another diagram for you. It is in a Word document, in a separate document. I have posted this document on the Blackboard already. Let me show you that. Okay, use this one, I think easier, because this is an example for PTT stock, right? And this is baht and dollar. I think easier to understand. So two purposes here. First, I want to show you how ADR is created. That's first objective. Second objective is that I want to show you that the dollar price of ADR, the price of ADR in US market could be affected by the exchange rate. Therefore, this kind of instrument expose US investor to exchange rate risk. Okay, that's the second purpose. I want to show you that. Okay, let's start with how ADR can be created. First, right, assume that US investor, okay, US investor has expressed interest, right, to the US financial institution, the green one. This is US financial institution, US bank. So US investor has expressed their interest to the US financial institutions that they have the interest in investing in Thai stocks. Let's assume that is the PTT stock. So now US financial institutions know that there is demand for PTT stock in the US, right? But these investors do not have direct access to the Thai market because that is quite complicated to do, right? Furthermore, to understand various aspects of PTT, right? The documents involved are mainly Thai, right? Not English. So difficult to buy the stock directly. So US financial institutions know that there is such demand in the US market. So what they can do is that they can buy PTT stock in the Thai market, right? And then place that stock, right, with a custodian bank and issue ADR to represent the ownership of that stock that is held with a trusted custodian bank. So let's assume that, right, PTT stock in Thailand is traded at 30 baht per dollar. That is the price of the stock, 30 baht per dollar. And further assume that the exchange rate at the time is also, I said it wrongly, the PTT stock price is 30 baht per share. I think just now I said per dollar. It's 30 baht per share. Okay, the exchange rate is 30 baht per dollar. So that's the information at the time. So to start the transaction, the US financial institution will first have to buy Thai baht. So sell $1 and buy Thai baht. And after that, right, use that 30 baht to buy the stock. So basically this stock of PTT cost the US firm, right, US financial institution $1 to buy. And then after receiving that stock, right, the US financial institutions will then place that stock with a trusted custodian bank and issue ADR to represent the ownership of that stock. So this is called PTT, ADR, right? This is called PTT ADR. Then the US bank can sell PTT ADR to the investor. Let's assume away the profit first. So sell that stock at $1, right? Sell ADR, right, at $1 per ADR. Assume that one ADR cover one stock. One ADR can cover more than one stock, depending on the multiplier that you want to use, right? But in this case, I assume one ADR for one stock, okay? So now US investor hold PTT ADR. Over time, when PTT company in Thailand pay dividend, that dividend will be paid to the custodian bank in Thai baht term. And the custodian bank, right, will then convert, right, that Thai baht dividend into US dollar and then pay it to US investor. Basically, US investor deal with this investment, everything in US dollar. So US investor can avoid having to deal with exchange rate. But there is a risk of exchange rates, right? Because the dividend in Thai baht, right, if received when Thai baht depreciate, of course, we can convert into less dollar, right? So the investors still have to face exchange rate risk, right? But it is more convenient because they don't have to exchange money by themselves, right? Let financial institutions do that. The bid-ask spread they face will be narrower, right, than what the investor can do by themselves, right? So that becomes cheaper to deal with. Next, if the US investor, right, want to liquidate this investment, the US investor can actually sell that ADR in secondary market. So if the price of ADR in secondary market changes from $1 to something else, then that investment will create capital gain or capital loss to the investor. Okay, so that's roughly how ADR can be created. Next, what I want to show you next is that the price of ADR in secondary market can be affected by the exchange rate between Thai baht and US dollar. And this is why US investor will face exchange rate risk from this kind of investment. Okay, to show you that, right, to show you that, I would like to assume some extreme case. Okay, let's assume some very extreme case. Go down. I assume that, right, after purchasing that PTT ADR, right, the exchange rate has moved from 30 baht per dollar to 28 baht per dollar. So basically, after the investor purchased the PTT ADR, dollar has depreciated against Thai baht. In other words, Thai baht has appreciated against US dollar. Then assume that everything else is the same, except for the exchange rate that moved. Right? So I want to show you that, right, even though everything else is the same, this exchange rate movement can cause dollar price of the PTT ADR in the market to move. Okay, and that move will cause investor either capital gain or capital loss. Right? Before calculation, let's use logic to think about this situation first. In this case, right, Thai baht has appreciated against dollar. Now, this investment, PTT ADR, the underlying stock is PTT. The underlying asset of this ADR is Thai baht based investment. So you still have to think about this as baht based investment. So if Thai baht appreciate against home currency to the US investor. So those US investors who have exposure to baht investment should be having benefit, right? Baht appreciation, right, should give more profit to investor who invest in baht-based, right, investment. So before I do more detailed analysis, right, I would guess that this would result in US investor getting more profit. Okay, let's see why that is the case, right? After the exchange rate has moved, right, to 28 baht, if nothing else in the market change, then there will be arbitrage opportunity. How? Okay, this is how. Right, after the exchange rate moved to 28 baht, and assume that nothing else changed at all. Right, this will create arbitrage opportunity. Basically, right, arbitrager will borrow 28 baht to buy $1. And since I assume that nothing else changed in the market, so therefore the price of the ADR is still $1. So after receiving $1, arbitrager will buy 1 unit of PTT ADR and then go to the custodian bank, right? And since ADR means that the holder of the ADR is the owner of that stock. So the investor who hold ADR can always go to the custodian bank, right? Return ADR, right, for the actual stock. That can be done. So arbitrager will go to the custodian bank, return ADR, and ask for the actual stock. So this will cause less supply of ADR left in the market because part of ADR has been cancelled, right, by this third transaction. Then the arbitrager will sell PT stock, right, back to the Thai market at 30 baht. And we know that at the start, arbitrager only borrowed 28 baht. In the end, received 30 baht. That 2 baht difference is the arbitrage profit. Don't forget, all these transactions are done simultaneously, almost zero cost of capital. So that would create 2 baht arbitrage profit. So if the price of ADR in US market doesn't change from $1, right, this opportunity exists. So as more and more arbitrager enter into these kind of transactions, less and less supply of PTT ADR will be left in the market. And that should push the price up from $1 to something higher. And therefore, those who still hold PTT ADR will now have capital gain, right? So basically, this is how exchange rate can affect the price of ADR. And that results in exchange rate risk for US investor. Now, let me summarize before we finish. Okay, just 2 minutes to summarize. Just give me 2 minutes, right, to summarize. I forgot to check the time. So from the perspective of US investor, right, from the perspective of US investor, you have to go to the last page. Basically, this kind of instrument allow US investor to get access to foreign investment without having to deal with foreign currency, without having to deal with foreign laws, without having to deal with foreign language documents. Right? Therefore, it is a lot easier for them. Furthermore, if we want to buy stock in Thailand, let's say I'm a US investor, want to buy stock in Thailand, I have to search, right, from 500 stock, which stock shall I buy, right? But when it comes to ADR, right, at least I can treat financial institutions as a person who filter for me first, right, which are interesting stock, right, and then they create ADR for those stock. So that reduce, right, my searching cost, right? It helps US investor to reduce searching costs, right? Because US financial institutions will be the one that filter, right, interesting stock first, and then create ADR on those interesting stock only. So US investors have less choices to make, basically. ADR can be constructed in such a way that the size, right, the par value of it, right, resemble to the par value of stock that US investor used to, right? Because one ADR can cover more than one stock. That's benefit to US investor. It also allows foreign firms, right? You go back one slide. From the perspective of the foreign firms, right? It allows them to get access to equity financing without having to do a full cross listing, which is more expensive. Okay, so that's the idea, right, of this market. I think that's it. Right, let me stop first. Next week, right, we will switch, right, to the other side of the market. That means next week we will look at the international financial market from the perspective of investor, right, especially equity investor, right? And I plan to spend about 2 hours, right, or less on that topic. And after that, I will move to the next topic that is about how the cost of capital can be calculated, which is related topic. So next week, right, please read topic 11 and 12 all together. Okay, I want to cover both next week, right? Okay, I think for me that is it for today's class.